we've seen so many IPOs. Second quarter was very strong, average return of about 34%, but that's mostly on the first day. So that really means that retail investors have been left out. Is that an issue? Weren't SPACs and direct listings supposed to democratize this process a little better?
You know, I think in the long term, the thing that really matters is the performance of the companies. In the near term, the fact that we have IPOs, we have direct listings, we have SPACs, that sort of innovation in the financial markets is good for founders. Ultimately, it's going to be good for consumers too.
So on a day that we have 17 listings, what should investors be looking for to separate sort of those longer term bets, even if we see that initial IPO pop?
I would zoom out. So if you zoom out, if you boil it all down, in the last 15 years, there are two things that have driven all of the market cap creation. It's consumers refocusing their attention around mobile, and it's enterprises replatforming for the cloud. I think if you have a company that is tethered to one of those two trends, it's well positioned for the long term. If not, then it may be a moment in time.
Now, we just had Stuart Butterfield on earlier. I know that you saw a bit of that interview. How has the shift to remote or hybrid work affected startups? Are you seeing more, not just in Silicon Valley, but beyond, forgo their traditional headquarters, different kinds of companies coming up because of that shift?
You know, we're actually seeing a little bit of an unbundling. So if you think about office space, you've sort of bundled work and relationships. You can actually unbundle those too. In a lot of cases, you can work more efficiently remotely, but then you have to dedicate extra time to building those relationships. So we actually see a lot of startups sticking with remote work, but then making a point of having more team get-togethers, more offsites, more dinners, and really solidifying those relationships that sometimes you lose when you're not in the office together every day.
Pat, talk to us about staying private longer versus going public. I'm sensing maybe there's somewhat of a shift. Particularly, the SPAC market seems to have opened up a possibility for younger companies with perhaps less proven models to come out earlier, which could offer more opportunity and risk to investors. Has the mindset shifted in this market around, I mean, aside from Stripe, around how long you stay private?
You know, I'm glad you mentioned Stripe because I was going to start there. Stripe's a good example, and we partnered with them back in 2010. It was a couple of brothers who had yet to process a single payment. And you fast forward a decade or so, and the company is a monster, and their best days have yet to come. I think Stripe's a good example of companies who want to stay private longer. SPACs, on the other hand, SPACs provide a pretty interesting alternative because it allows you to tell a more nuanced story. So within the Sequoia portfolio, we had 23andMe, which recently went public via SPAC, which is a consumer genetics business that also has a drug company on the back end. We have Embark Trucks, which recently announced a SPAC, which is a self-driving truck company. And then we have Bird, which is a micromobility company, which is responsible for a lot of the scooters you see around cities. Each of those businesses is a little bit of a non-traditional or a novel model. It's not as straightforward as your typical SaaS company. And so having the ability to tell a more nuanced story, which a SPAC provides, is very good for them.
So how does that get better for the investor, for the public market investor, you think? Is there more disclosure that could take place? Is it a matter of rethinking the roadshow? I mean, there's a lot of questionable companies that are coming public in SPAC, but then also a lot, you mentioned 23andMe, that have strong track records and strong brands as well.
Well, I would start by saying accountability brings out the best in people. And so the fact that some of these companies can access the public markets earlier than they otherwise might have is ultimately good for public market investors. It's a countervailing force to the trend of staying private for longer. It actually gives public market investors access to a longer menu of opportunities.
Yeah, we've seen some targets, especially sort of in the EV space, get scaled down not too long after they presented their investor thesis to retail investors. And there's still so much money in private markets. So I wonder, do you think that the retail investor in public markets are offering better terms than private markets? Is that why you're seeing more companies go public via SPACs?
You know, it's hard to say where you could find better valuations and better terms and that sort of thing. I think the important thing is to assess the underlying fundamentals of the business. EV, as you mentioned, is an area we've largely stayed out of here in the U.S. AV, by comparison, autonomous vehicles, we think is one of the most important trends of the next 10 or 15 years. And so we have a couple of companies, Embark Trucks and Aurora, that are very well positioned there.
I got to ask you about Robinhood, one of the most anticipated IPOs of the year. Just this morning announcing that they settled with FINRA, record amount. Does that further pave the way for an IPO? And you mentioned Stripe as well. A lot of people have been waiting for that one to go public. What is sort of the deciding factor to make them take that leap?
I certainly can't comment on the specifics of IPO timing for either one of those companies. I can, however, say that one of the beautiful things that Robinhood has done is it has democratized access to the financial markets for a much broader swath of people than had access before. And so in the fullness of time, we think that's going to be a very powerful thing.
For a price, though, right? Their business model, payment for order flow, has been a controversial sticking point. Do you think they've moved beyond that and have sort of let their investor base know enough about that model, and this is the right one for them when you have other trading platforms using different models?
So payment for order flow was a feature of the financial markets long before Robinhood came along, and it is one of many ways that they generate revenue.
Right, except they characterized, or maybe it was the broader landscape characterizing it as commission-free trading, which it was. Anyways, Pat, thank you so much for being with us today. We hope to talk to you again soon in person.
Thanks for having me.